I bet you opened your app this morning and checked the market. Maybe you felt confidence, maybe worry, depending on which way it moves.
So here's how I'm thinking about the next 12 months. 3 macro paths and 1 independent risk that sits on top of all of them. The first 3 paths are mutually exclusive and sum roughly to 100%. The 4th sits independent. These probabilities you see on the board come from triangulating Polymarket prediction markets, JP Morgan research, the Bankrate economist survey, and Morgan Stanley and Vanguard's 2026 outlooks. Broadening. The Strait of Hormuz reopens, oil retreats, CPI cools. The Fed has the cover it needs to start cutting rates again. The parts of the market begin to widen outside the Magnificent Seven. This is great, and it's the most likely path, but it's also not the majority case. Price shock. 15%. The Hormuz Strait stays closed through September. Oil sticks. CPI runs above 4%. The Fed has to hike again to protect credibility. The consumer doesn't wait. They pull back because the cost of living is, well, now the cost of living. Layoffs follow. Next, the consumer shock. Prices don't spike, but they climb enough that consumers get spooked. Sentiment breaks first. A bad GDP report convinces them that there's no going back. The Fed cuts aggressively into the slowdown, but it's reactive, not preventative. And then finally, AI reckoning. 30% that's already there. Magnificent multiples compress. Hyperscaler CapEx guidance turns negative. A drawdown of 15 to 25% concentrated in tech. Now, this isn't a forced scenario, it's a ring around the other 3. It can land regardless of which macro path plays out. So 2 of the 3 macro paths involve a recession, and in any of those paths, there's a 30% chance an AI correction lands on top. This is the environment I see in the next 12 months. And here's where most financial advice goes wrong for someone in their 50s and 60s. You've spent 30 years training your brain to seek one thing: alpha. Pick the right advisor who picks the right stocks. But at our age, with $2 to $5 million accumulated you most likely don't need more alpha. You need to know what your wealth is for. Income, flows that still pay the bills without selling down assets in a bad year. Dividends, bond coupons, predictable distributions. Really, the boring part of a portfolio that lets you actually retire when you say you're going to retire. And real diversification. Not all the companies that own this top 10 companies, international exposure, sector outside tech, different return streams, protection against concentration risks sitting in the index when you chose it or not. So alpha, income, diversification, AID. The first one is what got you here. The second 2 are what gets you through what's next. So here's what most affluent investors in this demographic are actually doing right now. Capital Group analyzed 1,790 advisor portfolios last quarter. The average portfolio is 72% in US stocks. 21% of the holdings pay no dividend. The passive US equity exposure is almost half of the portfolio. So the average mass affluent investor in their 50s is now more concentrated, more growth-oriented, and less diversified than at any point in modern memory. Here's the reframe. Most financial commentary you'll read in 2026 will argue about which scenario plays out. Bull case, bear case, soft landing, AI bubble. Everyone will have a position. Most of it doesn't matter because even when the market is right, even when fundamentals are strong, earnings are real, the rally is justified. That doesn't tell you what your portfolio should be doing. The question isn't which scenario is right. The question is whether your portfolio is positioned for what your wealth actually needs to do, regardless of which scenario plays out. That's the work of this stage. And it's the work most investors aren't actually doing.